All right, well, good morning, everyone. Thank you so much for joining us for our first webinar here at My Financial Coach. I want to thank everyone for showing up and spending a little bit of your morning. So just a few housekeeping items before we get into our presentation with our panelists. I want to thank, of course, all of our panelists for sharing a little bit of their time with us, as well as our headliner, Dr. Laffer. Thank you very much for joining us. So without further ado, I'd like to introduce Bill McDonald, who is going to introduce our other speakers for today.
Yes, good morning or good afternoon, depending on where you are today. We're honored today to have one of our directors and shareholders and one of my best friends, Dr. Arthur Laffer, speaking to us today. Many of you may not be familiar with My Financial Coach. So let me just give you a little background on it. 3 years ago, we put together a group of investors, including Dr. Laffer and others, to bring unbiased, unconflicted advice to people in the financial planning world. So here at My Financial Coach, our certified financial planners are all salaried employees, and they provide comprehensive financial planning and don't sell any products. Now, as we do these plans and we dig deeper into one's financial situation, we have vetted out an esteemed group of subject matter experts in legal, tax, accounting, insurance, investments, etc. So let's get started. Our first subject matter expert is Don Kirsten. He's a managing director of Executive Benefit Solutions. Don spends his time working with both publicly traded private companies and nonprofits designing and administering non-qualified executive benefit plans. Don has over 20 years of experience in the business. Don?
Thank you, Bill. And on behalf of EBS, we really appreciate the opportunity to spend a little bit of time today talking about a concept that I think many people are not aware of. And that concept is known as the source tax provision. So, Enpo, if you want to pull up the slides, go forward. So before I talk about that, Bill did a nice job of kind of talking a little bit about our firm. We started our firm in 2014, although we've been around, all of us have been around for much longer than that. And as Bill said, what we really focus on is designing plans that will attract, retain, reward key employees. And those types of programs really come in a lot of different types of flavors, depending on the structure of the organization. So some of the common types of programs you might be familiar with: deferred compensation, phantom stock plans, SERPs, split dollar life insurance strategies, etc. So we're a national firm. We have 6 offices around the country. We're in every time zone, and we're full service. So next slide. I'll skip this one because Bill did a nice introduction of myself. So let's talk about the source tax. The source tax came around in 1996, and you can see the code section there on the screen. But basically, it prohibits states from imposing income tax on the retirement income of non-residents, regardless of when and where the income was earned, as long as the retirement income is paid after termination of employment. And most importantly, and the retirement income is paid over 10 years or more. So most people who are aware of this think of this in terms of non-qualified retirement plans, but it also applies to qualified retirements as well. So with payments structured this way, and I've got an example coming here in just a minute, you'll see that the individual would only pay taxes in the state of the residence when it's paid, not in the state where the income was earned and deferred. So this can be a real benefit to those individuals that live in high tax states such as California, New York, Illinois, Connecticut, New Jersey, etc., and move to lower income tax states. The example we're going to use here is actually a 0 income tax state, but it doesn't necessarily have to be that. So another way of thinking about this, to use California as an example, So if you work in California, the highest income tax bracket right now is 13.3%. And you were to retire to Nevada, you would have deferred the income on the front side and had tax deferred growth, and then not had the any taxes on the back end. So for every $1 million in this example, you could save $133,000 in state taxes. So this is just a brief example I'm going to do. We've got a Joe here whose current state of residence is in California. His current salary is $400,000 a year. It's growing at 3% a year. He's going to defer $100,000 for 12 years into a deferred compensation arrangement. And he's going to retire at age 62 and relocate to Nevada. I realize the numbers here are pretty small, but I'll just focus on a few items here that I've put in yellow highlights in this example. So his final salary would be $563,000. His account would have built to almost $1.8 million. And this is assuming he doesn't, this is example assuming he doesn't take advantage of the source tax provision. He would have had to pay taxes, overall taxes of $937,000. And so the bottom line is he would be able to, over 10 years, draw down $112,000. Now, that's not terrible, but there's a way you can improve that. So again, let's look at Joe's situation, and you're going to see that he's got some significant improvement in terms of his income. So here we've got the same situation, his final salary, the same amount that his income built to, but because he draws this income down over 10 years, instead of $112,000, he's going to have $144,000 he's going to be able to draw out over this time frame, over 10 years. So he's going to have an increase of 29% in his income, and his effective tax rate has gone down to 37% rather than the overall 37 plus whatever he would pay in the state of his residence. So this is just a chart that gives you a little better idea of what we just talked about. You can see the taxes that have come out, what that account builds to, and the bottom line that he has 29% more income at the end of the day by using the source tax provision. Now, again, the source tax provision, there's certain specificity. You have to take the money out over at least 10 years. Again, you have to move to another state of residence. But in those situations, and more people are moving when they retire to get out of high tax states, this can be a real benefit. So again, thank you very much, Bill and the MFC team, and I'll pass it back to you, Bill.
You can see the value of our subject matter experts that we lean on whenever our clients have gaps and so forth. When our clients run into a number of gaps in their program, we have lots of resources that we can lean on, like the three individuals that you witnessed today. We also have board certified estate planning lawyers, tax experts, CPA firms, etc. I know you've all signed up today to hear Dr. Arthur Laffer. So it gives me a great pleasure to introduce Dr. Laffer. We've probably known each other for 35 plus years. He's a dear friend of mine, and as well as one of our directors and shareholders. So if you Google Dr. Laffer, you'll see 207,000 pages on Dr. Laffer on Google, which when you think about introducing Dr. Laffer, we would spend the next probably 30 minutes just with an introduction. But let me give you some highlights. Dr. Laffer was the first to hold the title of chief economist at the OMB under George Shultz. He was also a professor at the University of Chicago under George Shultz, also taught at USC. He was a member, of course, we all know, of President Reagan's Economic Council. And also, Laffer was an economic advisor for Donald Trump in 2016 during his presidential campaign. And on June 19th, 2019, President Trump gave him the Presidential Medal of Freedom for his economics. Gives me great pleasure to introduce Dr. Arthur Laffer.
What great presentations, Bill. Those three presentations were wonderful. I mean, really very proud to be part of the team here. It's just really neat. And I'm also sort of a little bit ashamed that I'm going to be a big letdown from the three prior talks who really had valuable information. I got notes all over the place here. I'm going to become the client as well as the shareholder as well as the board member. So I'm going to do all of that. Let me just start off, if I can, with the pandemic hitting in March, let's say, of 2020. Government spending was the first one, was $3.5 trillion under Trump, President Trump. Then we had $1 trillion at the end of the Trump administration. Then we had Joe Biden's 1.9 trillion. I think that puts us up to about 6.4 trillion. We now have another program out there called infrastructure, which is another 3 trillion or 2.5 trillion. These are very, very large numbers that will have a material impact on the economy. Joe Biden has just proposed raising the corporate tax rate from 21% to 28%. As you may know, the 2017 Tax Act and Jobs and Tax Act reduced that rate from 35% to 21%. Joe Biden has also proposed raising the minimum tax abroad, the minimum tax, from 10.5% to 21%. And there's also talk about having a minimum business tax in the U.S., a minimum of 15% on all corporate income. And there's a lot more stuff to come. I mean, believe me when I tell you, this is just the beginning. This administration has decided to do this through reconciliation, which means all it needs is a simple majority to pass. And given the Democratic composition of the Senate and the House, there's no chance that it won't pass. It will be passed. So from my standpoint, this is what I want to talk about with you, and sort of what the macroeconomic consequences of something like this could be. Now, relative to U.S. history, a 28% corporate tax rate is not all that high. It's much higher than 21%, but if you noticed from 2016, the highest corporate tax rate in 2017 was 35%. This would be less than that, but it still would be very much higher. If you look at it in a historical perspective, 28% is not all that high by U.S. standards, but that's not the way to look at it. The way you really want to look at it is to compare it to other countries, and you want to look at it cross-sectionally. If you look at it in 2016, at a little bit at 35%, if you take state and local corporate taxes as well, in 2016, the U.S. corporate tax rate was 38.92%. That was the highest. Now I'm talking about the highest rate. That was the single highest in the world. None higher out of 36 countries. In 2018, that tax was dropped from 38.92% to 25.84%. That again includes state and local taxes as well. That put us 14th out of 36 countries. What Joe Biden's tax proposal would do would be, once it went, propel the U.S. back up to being the highest tax rate in the world, the OECD world, out of 36 countries, at 32.37%. So no matter how you cut it, the way you want to look at the corporate tax is look at it in comparison to other countries. We are in a tax competition in this world, and if our tax rates are the highest, you're going to find bad consequences from it. And I hope I'm not going over any of your heads, but if you have two locations, A and B, if you raise taxes in B and you lower them in A, producers and manufacturers and people are going to move from to. Am I going way over your heads on this? Just joking. What you'll find here is you'll find the U.S. becoming non-competitive. President Biden was asked about that yesterday, and he said, no, there's no evidence to suggest that people use taxes in making any of their decisions. Internationally, it just doesn't happen. It's just there's no evidence whatsoever. That, by the way, is not true. If you can look at the U.S. now, I'll take you back when we had another very major tax cut, corporate tax cut. In 1986, the U.S. had the 9th highest tax rate, corporate tax, out of 21 countries. Now, it was a smaller sample. It didn't include Japan, for example. Had the 9th highest tax rate, but our tax rate back then was 49.82%, much higher than it has been in recent times. We were 9th out of 21 countries. President Reagan, in the Tax Act of 1986, cut that rate after 2 years down to 38.59%. That made us 17th highest in the world out of 21. We were right in the bottom group there. As you know, that was the boom of the 80s. It was called the Roaring 80s. It was incredible. What happened when Reagan did that was inversion stopped, as you'd expect. We became one of the lower tax rate countries in the world. All the inversions that were coming before the 86 Tax Act all of a sudden disappeared. But as time went on, there were changes in the world that followed the leader countries. And what has happened is all these other countries have reduced their tax rates, and it's a competitive world now for capital. And that is what we've sit at now. Today, we would be putting ourselves back up as the highest tax rate. My guess is you're going to see substantial inversions occurring once this happens. Now, I know he has a 21% penalty tax if you do have an inversion, if you do take your funds abroad. But I'm thinking that businesses will find a way. All they need to do to find a way is, all they need to do, Bill, is call my financial coach. And you have subject experts, I'm sure, in this area too, that can show the companies how they can get around the tax cuts, around the minimum. I mean, it's all just a lot of tax. What happened after the Trump's tax bill? And I want to go through Trump's tax bill with you, because what Joe Biden is proposing is sort of playing the film backwards. What Trump did was he cut the highest rate from 35% to 21%, cut the personal income tax rate from 39.6 to 37. He had the pass-through. He had all sorts of other proposals in there. What President Biden is proposing is reversing that process. And if he reverses that process, my view is that you'll probably have the consequences reversed as well. And I just want to go through what happened when Trump did the tax bill in 2017. When he did the tax bill in 2017, all right, if you look at the stock market of the U.S. over the next 2 years versus the Eurozone, the U.S. stock market outperformed the Eurozone in the next 2 years by about 25%. The U.S. stock market outperformed the Japanese stock market in the next 2 years by about 25%. Over the next 2 years, the U.S. and China were about even in the stock market. The China went way up and then came back down. But basically, we were even with China. We were way ahead of Japan, way ahead of the Eurozone as well. GDP, now I'm going to look at GDP here from the first quarter of 2016 through the third quarter of 2017. That's almost 2 years. In that 2 year period, if you look at it, growth rates by quarter, the U.S. and the Eurozone matched each other precisely. I mean, it was the second decimal place that they didn't match each other. Once we got to the fourth quarter when the tax bill passed and it started its effects, the U.S. outperformed the rest of the world. In fact, outperformed the Eurozone by a lot. Every single quarter they outperformed it, and outperformed it by a lot, except for the fourth quarter of 2018, which we didn't outperform, but all the other 7 quarters we outperformed it. After a single year, U.S. GDP was 1.1% higher than it would have been had it grown at the Eurozone growth rate. We ended up giving a huge amount of growth to the U.S. after 1 year. After 2 years, U.S. growth was substantially higher than the Eurozone. It was higher by about 2.2%. 2.2%, that's about $400 billion. That's a lot of money. It's $400 billion. It's a huge amount of money. Our growth rates were so much better than the Eurozone that we had grown by 2.2% more than they had, even though we had been even with them in the previous 2 years. It's just incredible. If you look at tax revenue, now what I did here with tax revenue, I took total federal, state, and local tax revenues, total, and I looked at the 2 years before the Trump tax cut, the Tax Cut and Jobs Act of 2017. I looked at it for the 4 years ending, for the 2 years ending in the third quarter of 2017, and then looked at that same 2 years going out, and I looked at the growth of tax revenues, total federal, state, and local tax revenues in the 2 years prior to the tax cut, and then the growth in tax revenues for the next 2 years. So it's comparing a growth with a growth that's not a level. And during that period, the growth in tax revenues increased in the 2 years following the tax code. Now, obviously, they dropped dramatically in corporate tax revenues, but they picked up substantially in other federal tax revenues and in state and local tax revenues. But even if you look at only federal tax revenues, there was an increase in the growth rate of federal tax revenues following the Tax Cut and Jobs Act of 2017. I think the growth was 1.9% growth in revenues in the 2 years preceding it. It was 2% growth in revenues in the 2 years following the tax cut. It's not only that, but if you look at payrolls during this period. Now remember, this is the longest recovery that occurred in history, and literally in history. And the payroll growth in the 2 years following the tax cut were almost the exact same as the payroll growth in the 2 years leading up to the tax cut. So there was that growth just continued on way beyond where it should have naturally by that. Now, the last one I want to talk about with you that I think is really, really important here is real wages, and that's median real wages. For example, during the Obama 8 years, the median wages were about $60,000, and the increase under the whole 8 years of Barack Obama was a little bit over $1,000. That was the total growth in those 8 years. In the 4 years of Donald Trump, the total growth in wages, median wages, was $6,500, a huge increase in the growth in median wages. And as the campaign pointed out time and time again, minorities, the poor, the disenfranchised, the less educated were the biggest beneficiaries there. What I am expecting to happen here, and I don't know what all the details will be, but I'm quite disappointed with with Biden, because I really thought he'd be a better president than he's turning out to be. But I think you're going to see some major tax legislation here. When you look at the U.S. economy, I think it will inure very much to the economy's detriment. Now, I've got to leave you with a little bit of good news. Is that all right? Is that I can try to give you? We had a very similar situation in 1992. In 1992, Jerry Brown ran against Bill Clinton in the Democratic primary. I was Jerry Brown's tax advisor back then. We had the 13% flat tax. We came in second in the race in the Democratic primary, but Bill Clinton won the election. Then he won the election against George Herbert Walker Bush. And of course, the first thing he did when he came into office was to put in the tax increase. As all of you know, that he had a control in the House and he had large control in the Senate. This tax increase raised the highest marginal income tax rate to 39.6%. It increased the corporate tax rate as well. All right, all of that he did. Not one single Republican in the House voted for that tax increase. Not one. Not one single Republican in the Senate voted for that tax increase. All right? In fact, a number of Democrats in the House and several Democrats in the Senate voted against it as well. In the Senate, the vote was 50-50. The tie-breaking vote was Al Gore, alias Darth Vader, came in and cast the tie-breaking vote to put in that tax increase. All right? That's your background. The election of 1994. Not one single Republican running in the House for re-election lost. The U.S. the Republicans picked up something like 58 seats in the House. Picked up 58 seats and took control of the House. In the Senate, not one single Republican running for re-election in the Senate lost, and the Republicans took control of the Senate as well. Just as adding a little bit of flavor to it, if you enjoy flavor, not one single Republican running for re-election in the governor's races, lost, and that includes 2 Republican governors who were under federal indictment. They still won. That's supposed to be a smile. I want to see someone smile at least a little bit there. Thank you. The Republicans swept the governorship, they swept the Senate, they swept the House, they swept the state legislatures like you've never seen. I believe that this is going to be very similar politically to what was done under Bill Clinton. I don't know how much backbone there will be for any Democrats not to allow all of these items to go through, but I doubt very much if there will be any type of stopping of this bill that Biden's putting through. But what you can do is look to the year 2022. I think that would be a very good year for the House. And I think as things go on, this will be a big change. This is not a popular measure, I don't think, what he's doing. And I think it will hurt the economy. But I do think it will lead to a very major change in politics, which will bring back saneness and common sense and good economics back to the U.S. And with that, I'm just going to throw it open for questions, Bill. I hope I haven't been way too long. By the way, I wish I could be as expert as your experts. I listen to them and I'm awestruck.
Well, thank you, Dr. Laffer. We do have a number of questions that people have typed in, and if you want to ask Dr. Laffer some questions, go ahead and type them in. Ampo is going to read the questions for Dr. Laffer.
Well, Dr. Laffer, it looks like we're going back to start where I interview you. So, Dr. Laffer, the first question comes from a Mr. Carl Youngman, and he has asked about the Janet Yellen proposal that all OECD countries adopt the same tax rates. What are your thoughts on that proposal?
I am a huge fan of competition. It is the gold standard of economics. In a perfectly competitive world, the marginal cost is the price, the marginal utility is the price. Everyone does things to maximize total output, total utility. Competition is just the cornerstone of good economics. Everything in economics holds as its gold standard, as the ideal system is a perfectly competitive model, and that's what creates the most benefits, the most welfare for the overall society. I'm going to tell you, Empo, that model does not stop with people and with businesses. It resides with governments as well. And whenever politicians agree on something, believe me, they agree on something that will disadvantage the electorate. They always conspire to get advantage over that. Anything that stops countries from being competitive is a disaster. Now, if you want to see how well it works in truth, is look at the United States. We have a central government that's very powerful, Janet Yellen, all those people. But we also have 50 states in this country have competed. Look at the benefits that the competition has done among states. Would you like every state to be New York or Illinois? Hello? No. The reason Illinois has to stop where it does, where Pritzker can't do he's done enough damage as it is, but they're all leaving Illinois. I was there in Nashville the other day, and I heard this couple talking with another couple, and the one couple asked the other couple, did you hear about the Tennessee family that packed up all their belongings, got everything together, and moved to Illinois? Did you hear that story? The other guy said, no, I didn't. He said, and you never will. We are seeing people vote with their feet. It's not correct to enslave people in any way, shape, or form, and enslaving them with tax policies or with social policies or with anything. I'm totally against. The more countries, the merrier, the more competition, the better it is. The perfect standard would be, the gold standard would be perfect competition amongst countries where they compete with their taxes, they compete with their spending, they compete with their regulations, and they face the competition to provide the best services at the best cost of all. That's what I'd like to see. And I think the Eurozone is a huge mistake. I'd like to see it broken apart into many countries. And I think anything that goes to a standardized minimum tax on the global scene is a disaster for economics as well as for individual freedom. Am I being too soft on that? Did I wonder if people understood what I said? I'm against it.
You've been very thorough in your response. Thank you very much. Bill, would you like to ask the next question? Oh, okay. So So the next question is, can you dispel the myth that wealth creation doesn't trickle down to average wage earners?
Well, I just did. In the last example I gave you was the Trump Tax Cuts and Jobs Act of 2017 reversed the process. Now, if you look at the median income, what I'm going to do is take the average income of the bottom 50%. And if you look at that number from 1943 on, now the reason I use 1943 is that's when tax codes became universal in the U.S. Everyone had to file a tax return. Prior to that, it was just a limited number of people were due. If you go back to 1913, 14, 15, when the income tax came into existence, very few people filed taxes. I mean, less than 1% of the earners did. So if you go to 43, if you look at it, the bottom 50%'s average income, all right, and I'm using a trend line of 1.5% relative to the top 1% or relative to the next 49%. All right, their average income has been going down, 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 down throughout the entire period until you get to Donald Trump. And then all of a sudden, bam, that thing just started skyrocketing. As I mentioned to you, I was on Larry Kudlow's show yesterday, and I said, and the median wages rose by 5,000. He said, no, Arthur, 6,500. So, it's a huge, we've had an increase in real wages of median wages of over 10% under Donald Trump. Let's see what happens here. I don't think it's going to go up still. These guys are, the dream in America has never been to make the rich poor. The dream has always been to make the poor richer. Ronald Reagan put it, my hero did, you balance up, not down. There's nothing wrong with being rich. There's something very wrong with being poor. And the thing that's wrong with being poor is they're poor. And what we just do is make sure that the poor have the opportunity to become rich. And that's what I love about you guys here and what you're doing is you're giving people a chance to make that really happen in our world. It's that competition, that drive that really provides the opportunity for people to break through those barriers and become personally wealthy, which is what we all want to be.
All right. Well, thank you for that answer. And actually, this one's going to be a bit more of a pick-me-up. So what are you most excited about in the economy for 2021?
Other than buyfinancialcoach.com, I can't. No, I'm excited about a lot of things. I'm an economist. So you've got to understand that I like data, even if it's not good data. The doctors at Yale, Epstein and Barr, became very famous because they discovered a disease, the Epstein-Barr. They got their names put on it. It's a great thing. I mean, they were very excited. The people who had Epstein-Barr were not nearly as excited as the doctors were. So as an economist with a little disease named after him called the Laffer Curve, I am very excited about seeing new data and making sure the models work. And the models, I think, will work. You've just seen me describe how I believe the model will unfold. So this is going to be a good test year, and next year's going to be a great test year for economics. And I'm very excited about seeing how the results come out. I feel sorry for the people. If my outlook is correct, I feel very sorry for a lot of people who are going to bear the consequences. But we'll have a lot of new data coming out. And as a scientist in this field, I just love these examples. I mean, it's Illinois. I love Illinois. I mean, compared to Tennessee. I mean, I really do. I feel very sorry for the Illinoisans, but it's a real classic case of competition. It really works. New York. I mean, what's happening in California? You couldn't get a better example. Are any of you from California? If you are, let me just tell you that you've got this thing going on today with Gavin Newsom. It is spectacular. I was there and very involved in the 2003 recall of Gray Davis. I personally like Gray Davis a lot. He was Jerry Brown's chief of staff when Jerry Brown was governor, and Jerry Brown did a great job with Prop 13 and getting rid of the death tax and all that. He was really good in the first 8 years of his term. He really was good. But Gray Davis had done that horrible thing with the electricity, freezing the prices of electricity, and all of a sudden the prices went way up and sucked all the money out of the budget, and it was just done. Then there was the recall. Let me take you through the recall, because you've got one coming on right now. Gavin Newsom, I guess they need 1.445 million signatures, valid signatures. They've already got a little over 2 million. They're assuming a 25% failure rate on the qualification for the signatures. I guess the rate is really 18%. So it looks like they're going to qualify. And if the Supreme Court of California doesn't do something awful, I think there's going to be an election. It's going to be an election in October. Let me tell you how that election works. Issue 1. Do you want to recall Gavin Newsom? Yes? No. Period. Then, whichever way you vote, even if you voted no, you still get the vote. If he is recalled, there's a second proposition. Which of the following people would you like to see the governor? Well, let me take you through the dynamics of what this is. All of a sudden, if he's going to be recalled, the Democrats are very worried that they'll pick someone who's not a Democrat on the right-hand side. So what they'll do is they're going to have a lot of Democrats sign up to be on the right-hand side, which will guarantee that Gavin Newsom will lose. There's a huge dynamic against Gavin Newsom succeeding on this recall. I believe it's almost guaranteed he will be recalled if that election occurs in November, just the way Gray Davis was. Now, if you'll remember when Gray Davis was under recall, his lieutenant governor was a guy named Cruz Bustamante. Cruz Bustamante, by the way, decided to run on the other side of the ticket saying, please don't recall Gray, but if you do, vote for me. He really wanted Gray to lose badly. And if you looked at it, of course, there were 150 people on the ballot in California. Strippers, there was Gary Coleman, the actor, remember that, Peter Uberoth, you got all these. I mean, it was just glorious. I mean, you couldn't ask for it. There was one guy in there, Arnold Schwarzenegger, who got elected. All you need is a plurality. All you need is just the most number of votes of that group, and you get to be the next governor. It's an amazingly dynamic process. I think you're going to see a new governor of the state of California. My hope is that it will be, I hope it's going to be Tom Selleck. I think that would be great. I think, you've got Faulconer coming out of San Diego. There's going to be an explosion in California that's going to be very, very exciting. And maybe a new era. And if you look at New York, I mean, Andrew Cuomo's got a problem. In fact, he's got a lot of problems. Who knows what's going to happen in those elections? But I can't see any of these things enduring to the benefit of the Democrats in this process. And now you ask what excited me. If you got enough of excitement out of me, this is going to be very exciting for me. I love this stuff. I don't want to lose my money, but it's worth the thrill. I wish Joe Biden had done a great job. I wish he'd followed Donald Trump's policies and done it, but he didn't. So now we got the thrill of the competition in politics.
Well, actually, following up on that, and speaking about the Biden administration, they're quoted saying that they want to grow the economy from the bottom up and the middle out. What are your thoughts around that?
That's just what Trump did. They will not do it. I mean, that's my thoughts clearly. Bill Graham put it very clearly. He said, I've never been hired by a poor man. And, you need rich people to provide the jobs, output employment. Benjamin Hooks, I thought, put it beautifully. And I don't want to play a race card here, please, but forgive me. Benjamin Hooks was, the head of the NAACP. And he said that, blacks are hired last and fired first. The only way we're ever going to get jobs and keep them, if there's so damn many jobs around, we have to be hired. And that's the way I like to think of this. There's nothing better for the minorities, the poor, the bottom, the middle, than having a rapid economic growth and prosperity. That's where you get all your social gains. Everyone who says tax cuts are racist or whatever they say, right-wing reactionary stuff, just the reverse is true. It is the only way you can make the system work and provide the opportunities for the bottom. What you've described today, Bill, let me just say what I've heard and what I love from my financial coach, is you've taken extraordinarily complex tax codes and regulations and requirements and made them available for people who are able to tap into myfinancialcoach.com. Okay, that's what you've done. Now, imagine some guy in the inner city. This guy's not wired. He doesn't know about us. He doesn't know. He sees this Ronald Reagan 75 stories of tax codes sitting out there. This guy just knows how to fry chicken. He fries chicken. He does it great when he creates this thing there. And all of a sudden he hits these tax codes. He gets audited. He gets convicted. He gets fined. The tax code guarantee that the poor never, ever, ever can become rich. It is a way of keeping those people, quote unquote, out of your country clubs, out of your neighborhoods, of the opportunities. If you believe in an egalitarian society as I do, the only way you can make sure that it's open for everyone is if you don't have these welfare traps, these glass ceilings. Get rid of all that crap and allow people to have a very simple tax code. And with this, I'll probably stop. But let me just tell you what I did for Jerry Brown and what he ran on. If any of you remember the race in 1992, we got rid of all federal taxes, all of them. We got rid of the personal income tax. Gone. We got rid of the corporate income tax. Gone. We got rid of payroll taxes, both employer and employee payroll taxes. Gone. We got rid of Medicare and Medicaid taxes, excise taxes, death taxes, capital gains taxes. We got rid of all of import duties. We got all of these taxes, all of them gone, with one exception. We kept a little category of taxes, which we call sin taxes. And the reason we kept the sin taxes is that their purpose is not so much to raise revenues as it is to change behavior. You know, I used to joke with people, we Americans don't like drunk people smoking while we shoot each other. All right? Those are the sin taxes we keep, the speeding fines, the fines, those are there to stop people from doing bad things. All right? That we had all that. And in their stead, we put 2 flat rate taxes, one on business net sales. If you're a Democrat, it's called a value-added tax. All right? Flat tax on that from the first dollar to the last dollar. No changes in the rates. We had a personal unadjusted gross income tax for all people. First dollar to last dollar. No exemptions, deductions, exclusions, no differences in rates, nothing. Just those 2 taxes. Now, the rate that came out to be static revenue neutral, no Laffer Curve effect on this one, with Jerry, came out to be 12%, 11.83% to match all federal taxes. Now, Jerry wanted a little bit extra. He wanted to pay down the debt, he said, but I think he needed a little bit more to spend. So he made it a 13% flat tax. All right? If any of you remember this in 1992, Jerry Brown's flat tax of 13%, and it would get rid of every single federal tax in the nation, just 2 flat rate tax, one on business net sales and one on personal unadjusted gross income. That's what he ran on in the left-wing Democratic Party. He went from 8th in the race out of 8 candidates. He called me. He flew down to San Diego, stayed with me for the weekend. We did this whole tax plan. He then ran on this tax plan. What happened is he went from 8th in the race to 2nd in the race. We were coming into New York and California. Woo-hoo! We had that blue-eyed fella from Hope, Arkansas on the ropes. I mean, we were pounding. I mean, the guy was glisten-eyed. We just won the primary in Connecticut. We just won the primary in Oregon, and we were coming in to take the wooden stake and put that through that witch's heart, okay? We're just coming 3 weeks out of the New York primary. Jerry Brown announces Jesse Jackson is his running mate. Well, the polls went the other way. But we still got the 2nd largest number of delegates in the Democratic Party with that tax plan. That's the way to go if you want to win votes, if you want to do the right thing for the country. A low-rate, broad-based flat tax. Get the IRS codes out of the way of the poor, the minority, the disenfranchised. Let them fly too. Let the light shine on them as well. Don't make it so they can't understand the codes and keep them trapped in slavery for the rest of humanity. Well, you hear my saying. That's what I'm looking forward to in the next one. I've got one more president I'm going to get, and it may be the same one coming back again. Who knows? But if we do, we're going to really do a job and create prosperity in America for the infinite future.
Well, thank you, Dr. Laffer. Thanks for taking the time out of your busy schedule. I know you're in Florida today, and we really appreciate you taking the time with us today. Now, Dr. Laffer has just completed a paper that he's going to make available. If you'd like to email us, we'll get you a copy of the paper. Again, Dr. Laffer, thank you very much, and thank everyone today for joining us here at My Financial Coach.
Just remember, My Financial Coach is the best ever. Bill McDonald's my hero. MPO. Woo-hoo!
All right, thank you, everyone. And for all the questions that we didn't get answered today, don't worry, we do see them in the chat, and we will email them to Dr. Laffer, and if he has time, he hopefully will be able to get back to us on that.
Right. All right. Thank you.
Bye now.